Good morning, everyone. It's Friday, October 27th, and today I want to make a video about a question that I've been asked a number of times, particularly from people who are just starting trading. They are asking about the scalping technique. Now, I know that when people start trading, almost everyone trades using a scalping technique. They make a couple of ticks or a couple of points and then they get out of the market because either they lost money or they made money, and they trade multiple times, 20 trades in one session, and they end up losing money. And over 90% of traders, new traders, lose money. And it doesn't have to be that way. So is the scalping technique at fault for that? I don't think so. Scalping is a viable means of trading, but it's a difficult way to accumulate money because you're going to win some, you're going to lose some, which is, of course, the way trading works. Really, you have to expect losses. But if you're going to make $5 and lose $7 and make $10 and lose $6, I mean, come on, it's going to take forever for you to make any kind of real money, and you'll be just giving it all to your broker in the form of commissions. So I want to go over a couple of points that I make to the students in my course, and particularly to those who are familiar with the Taylor trading technique. And I've been pushing the Taylor trading technique very, very heavily because it's something that I see works better than almost anything else. Trading is difficult, and the Taylor trading technique, used with some experience, is very effective at making money. So let me go over it. And I'm going to use 2 days as an example. I'm going to use yesterday, October 26th, and the day before. So that's a Wednesday and Thursday. So here we are, and this is my chart of Wednesday, October 25th. And this is a 3-minute chart of the S&P E-mini. There are 5 points between each horizontal line to give you a frame of reference. So 5 points, $250 on the E-mini, 25 on the micro E-mini. Nevertheless, the principles are all the same. Now, first of all, I want to draw your attention to the Taylor trading zone, which is a calculated area of the chart, which, according to the Taylor formulas, is where the market is likely to trade. I also want to point out the horizontal line, that is the previous day's close. The previous day's close is always a target, because the prices will hit the previous day's close 75% of the time when there's a gap trade. Now, on Wednesday, didn't happen. So 25% of the time it doesn't close the gap. But nevertheless, it's a very viable trade. It's a trade that every trader should have as a basic trade. Now, the Taylor trading zone is an area, again, as I said, is a calculation based on Taylor's formulas of where the market is likely to trade. And the absolute support down here at 42.29 and resistance at 42.77 is an area where the market is likely to trade. Now, because the prices are skewed by announcements almost every day, prices don't always trade exactly within the parameters of the resistance and support number, the absolute resistance and support number. But the absolute resistance and support number also gives us a range, a trading range for the day. And the trading range with Taylor is very accurate if you know how to use it. And so the trading range can be determined by the difference between the resistance and support. And this is the way you use it, and this is the way you can trade more successfully in terms of making money as a trader. Now, first of all, as I said, prices don't always trade exactly within the Taylor support and resistance number. But nevertheless, these two areas, the support and resistance number, are price targets. Just as the previous day's close, the gap is a price target. And almost every day, the market will hit one of these Taylor targets, sometimes both of them. But the Taylor trading range is particularly accurate. And the way you use it is when the market opens and you see, well, on this particular day, as you can see, many traders, I probably traded to the upside thinking that the gap was going to close, but it didn't. But the way to use Taylor and to make money is to use patience. And if you've seen my previous videos, you know I always say trade with lots of patience, and here's why. You want to find out, if you can, where the intraday high or low is. And the way to do that is to watch and use patience. Watch what prices do. Now, the market opened right here at 42.53 on Wednesday, traded down to the Taylor support level, and then bounced back up. But look where they went. They didn't, in going up, they tested the 42.53, but they never exceeded it. Actually, they didn't even come that close to it, but they never exceeded it. And this is important because the intraday high or low is usually put in the first half hour to hour of the day. So a guess, an educated guess, would be that this 42.53 was the high of the day, was going to be the high of the day. And so we can determine that somewhere after this candle put in this high at 11, just after 11 a.m., and then prices traded downward. And so making the assumption that 42.53 was the high of the day, we can take the Taylor trading zone and make a clone of it. I'm going to do that. And I'm going to bring it down to the intraday high. Okay? And so this will give me an area where the prices are likely to trade down to. And as you can see, where did prices trade down to? The transposed trading zone support at 42.06. So somewhere around 11:30, 12 o'clock, if you took this 42.53 being the intraday high, move the Taylor trading zone down to find where the market might trade down to, the new target, take a trade to the downside, get off here. Simple, right? And how much could you have made? Well, 42.06, call it 42.06, and you get on somewhere around 42.36, 30-point profit, a 30-point profit. Now, at the same time, if the market retreated and went back and tested this 42.48 number, you could get off with a minimum loss because this again was the test of the 42.53. Another day, let's go over to Thursday, the following day. Again, prices didn't trade up to the gap. There was a gap trade possibility, and prices never closed the gap, but they traded up and down. It was sort of a volatile day in terms of the market gyrating, but again, use patience. Using patience, the market made a high here at 42.05, tested that high around just before 11 a.m. at 4,200. So wait a bit and see what's going to happen here. Will the market again test the 42.05? It didn't. So anywhere around here at about 11:15 or so, we can take it to mean, or take the inference that 42.05 was going to be the intraday high. So again, take the Taylor trading zone, make a clone of it, and move the clone down to the intraday high, right here. Where did the market trade down to? Right over here to the transposed trading zone support at 41.55. And so you can do this all the time. You can break your habit of scalp trading, and you can make some really impressive dollars this way. But of course, you need the Taylor trading zone, and so you can get the book, The Taylor Trading Technique, at Amazon. It's an almost impossible book to read. The formulas are not provided. But fortunately, I've done the work for you. The Taylor trading calculations are available at my site at timelessdollar.com, right here at timelessdollar.com. And if you go to my site at timelessdollar.com, click on the Taylor Trading Calculator up on the nav bar, you can get yourself your own Taylor Trading Calculator, and you can use these numbers every day to become a more successful trader. And so that's my video for today. I hope you've learned something. This is Marv Eisen from Timeless Dollar Trading Academy. Trade safely, use lots of patience. Thanks for watching, and I'll see you in my next video.